have TVS Supply Chain Solutions with us joining in, where we are joined by Mr. Ravi Viswanathan, the MD of the show, and the Ravi Prakash, Mr. the Global CFO. Hello and welcome to the show.
Good afternoon. Good afternoon. Thank you for having us.
Now, I'll start off with the Q1 performance now. So this is the third quarter wherein we've seen the profitability continuing. I want to understand from you, what is the road ahead in terms of the profits and as well as the revenue growth picture, if you can give us an outline for the whole FY25.
Thank you. And I think it's been a good quarter one. We had a very good performance from a revenue growth perspective. For the first time in many quarters, we had a double-digit revenue growth, the company growing at almost 11% to 2,539 crores. What was encouraging was the fact that we grew across both our segments, be it the integrated supply chain solution services and the network solution segment. Both the segments grew handsomely, 8.1% on the ISCS and 14.6% on the NS segment. So we are extremely buoyed by that. And that led to our PBT growing for the fourth consecutive quarter. So over the last 4 quarters, we have built a very strong momentum, both in our revenue and in our margins, and that is resulting in our PBT growth. Our outlook going forward is to continue on this momentum, and we expect to have double-digit PBT and hopefully end the year on a very good note across the next 3 quarters. Specifically, I would say, what is encouraging for us is that on the network solution side, we see significant growth in our volumes, and that's again something which we have witnessed after about 3 or 4 quarters of flat volume growth, and this has contributed very handsomely to the global forwarding business, which resulted in the 14.6% growth in the network solution business. So overall, we are very confident about our revenues and our continuing momentum in our profitability.
All right, so the growth momentum to continue. Can you quantify in terms of percentage, what is the growth number that we should be looking out for in FY25?
I would probably not hazard a guess at this point in terms of our guidance in that sense. But what we are confident of is to continue the momentum and deliver the profit numbers that we are very confident of. So a double-digit profit number across the 4 quarters is really what our focus is. As we continue on our journey to ensure that we are amongst the top 50 global supply chain companies over the next 3 to 5 year period. So that is really the focus of the company. What gives us the confidence at this point in terms of that vision is the very strong pipeline that we have. We have over 4,000 crores of annualized revenue in the pipeline. And the quality of the pipeline is something which we are extremely happy about. Very significant large deals which are now part of the pipeline gives us the confidence that we'll be able to grow on this momentum that we have built. If you look at outsourcing itself as a trend in the Western countries, it is something which we started participating in a more concrete manner over the last 2-3 quarters. And if you look at what has happened, if I take the UK as a market, our average deal sizes used to be about 2 to 3 million pounds, and that has increased to about 9 million pounds in the last 12 to 15 months on the back of the very large deal that we signed with one of the utility companies in the UK. Similarly, in the US, our average deal sizes have significantly increased from about $4.5 million to almost $10 million. So more than twice in terms of the deal sizes. And that's coming on the back of the fact that we are now participating in a significant amount of tech-led large deals.
Right, that was quite interesting and to understand, and thank you for the breakup over here. But I also want to understand one thing which stood out in your past conference call was the 4,000 crore of pipeline opportunities that you've seen. Can you explain us when we can expect to see this in part of our revenue? What is the kind of conversion that we are looking at for this one?
Right. I think over the first quarter, we announced quite a few significant wins with very large aftermarket solutioning in the Asia Pacific market. We also announced a win in India with a commercial vehicle manufacturer. So we are converting many of these deals, and that is really feeding into the revenue. So about 246 crores of revenue for the first quarter has come on the back of new wins that we have had. So revenue in this quarter coming from new business wins have been about 246 quarters, which is roughly about 10.5, 10.6% of the previous quarter's revenue. So I think our revenue momentum is significantly assisted by the tailwinds coming from the pipeline conversion.
All right, that's fair. Now, if I want to look at some of your segments over here, so again, I want to understand more on the India side. If we take the integrated supply chain solution over here, I want to understand, we have seen this trend in Q3, Q4, as well as Q1. We've seen a 6% decline in Q1. Now, understand what's the scenario building here? What's the kind of outlook that we should be watching out for?
I would say Q1 was a soft quarter from an India perspective and probably reflects most of the industry. I would be very, we are at least confident of India, especially what we saw in the budget and the boost that the budget has given to the manufacturing sector, which in many ways will feed into the supply chain business. So we are confident going forward. Hopefully the festival season and beyond will give us the required momentum for us to have significant differential growth in India compared to what we're seeing in the rest of the world.
Okay, now coming to you, Mr. Ravi Prakash, I want to understand the margin pressure that has gone in the network solution business. So the last 3 years, if you had to see, 4.7% in FY24 as compared to 7.4%. Now, Mr. Viswanathan did mention that there was a volume pickup over here. So going forward, can we expect the margin recovery also to come back in picture in this segment?
Yes, it will be, but probably we are about a couple of quarters out. What has happened in the network segment is we have two businesses. On the freight forwarding side, rates as well as cost has gone up because of the Red Sea situation, and therefore margins are getting impacted. And the second part is we have a business called the IFM Integrated Final Mile, which we had already communicated earlier is in the process of a turnaround. And we expect that to probably start giving results from Q3 of this year onwards. So we are conscious of the fact that we need to get back to the margins that we had in the past, and we should start seeing that happening from Q3 of this year. I also want to point out, even though the question was on the segmental margins, that overall as a portfolio, the profitability this quarter we made 13.7 crores, which is a 100 basis point improvement in PBT margin versus the same period last year. So even though one of the segments is kind of holding firm, the other segment, which is integrated supply chain solutions, is helping us deliver better margins. So year on year, it was 100 basis points, which is in line with our medium-term goals. Our medium-term goal is to grow margin 50 to 100 basis points every year. So as a portfolio, we are quite comfortable that we can get there.
All right, Mr. Ravi Prakash, I want to stick with you. I want to understand the outlook which is going on with some of the major cost line items over here, be it the freight cost rates, the volume outlook over there. What is it currently, if we go and compare it to the Q4 picture, how are the cost items looking at the major ones?
If I compare with Q4, a couple of quick changes have happened. You will see that the business mix in some of our supply chain contracts has changed, and that is reflected in the material cost going up. And that's fine because we are actually doing more value-added work in some of our geographies, and that's driving material cost. But as a gross margin, we are still able to manage it. On the freight side, very clearly you'll see a growth in freight costs because of what I talked about earlier, the Red Sea situation. Volume has been good, but then the freight costs have also been up. We expect this elevated freight cost to continue, like I said, for a couple of quarters. Probably by the end of this calendar year is when we can maybe hope for moderation, but it's honestly anybody's guess. What we are doing from our perspective is, in the supply chain side of the business where we have strong revenue momentum, we are focusing on operating leverage to deliver margins. On the network segment where we have cost pressures because of external reasons, we are focusing on internal productivity. And as a portfolio, I keep coming back to what we had said. We intend to continue to deliver the 50 to 100 basis point margin improvement.
So freight cost moderation, maybe we can see it building up from the quarters coming forward as well. But now I want to understand what are the capex plans if you have to look at any of y'all can take this up. The capex plans for the overall year that we are looking at, and even if we go forward, this is a second part question to this. What is the mix that we are looking at in our segments? Are we expected to see integrated supply chains being more than the 55% level that we are seeing?
In general, there is a lot of momentum on the integrated supply chain solutions, even for the last few quarters. And we are quite encouraged by it because this is a segment where contracts are sticky, they are long term, they are predictable. Uh, we expect to see strength in that segment. How it will pan out in terms of mix, probably difficult to predict beyond what we are right now, but we expect the segment to do well. Now, to support this growth, there would be some capex required. Normally, we have about 1% of our revenue being spent in capex, unless we come across a very major strategic project where we may have to lay out one-time capex. At the moment, we would say that for this fiscal, we are probably at about 1% until if we come across any large project which requires an outlay, which we would be willing to do because the company's balance sheet is in a pretty strong position right now. Our debt, actually gross debt has come down. Our interest cost has more than halved over the last 12 months. And so we are actually in a pretty good position to use that flexibility to invest in capex if required.
So 1% is the level that we are looking at for the capex for this year going forward. But that was the final question. Thank you, Mr. Viswanathan, and thank you, Mr. Raviprakash, for joining and sharing your insights on TVS supply chains and the outlook forward for the business.
Thank you.